Well, hello, traders and investors. Welcome back to Wealth Down with me, Norbert Meinhardt. And in today's episode, we're going to talk about the top 5 stocks that are poised to outperform the market, but not because they're hype, but because of the fundamentals and technicals all align right now for high probability of return over the next 12 to 36 months, let's just say. So today we're going to break down and evaluate earnings, catalysts, risk, and some of the fundamentals that move the numbers to know exactly what's worth owning. Now, before we jump into this, don't forget, I'm not a financial advisor, and this is not financial advice, just my opinion on how I think about investing. So if you're excited about the video, like, subscribe, and let's get started with our first on the list, and that what is Meta. Well, while Meta dominates the social platforms like Facebook, Instagram, WhatsApp, and leads the world in a AI-driven advertising, after a massive run, right here from the downs of April, right here up here to almost hitting 800 at one time, the stock went down now and is trying to consolidate at this 600 price target. A couple of the earnings highlights, beat their on expectations, EPS, revenue, strong double-digit growth. Oh, I also did a complete deep dive into Meta. If you definitely want to check out that video, it's on my channel. Key drivers are AI optimized ads. The guidance was cautions due to AI infrastructure spending, which kind of sent the stock down a bit. You can see after their earnings, they went down. Now the Wall Street focus is on high ROAS, improved Reels monetization, and WhatsApp business expansion. Now, the stock dipped after earnings, but not from weak execution, but from rising capex. So a short-term cost, long-term dominance kind of scared our investors out of Meta. Mark Zuckerberg says, and I quote, "We are building for the next decade of AI, which is translated into lower margin now, but higher profits later." So now let's go over the technicals. Currently, Meta is oversold on an RSI on a daily basis. All of the moving averages currently moving downwards. The 20-day just crossed the 200-day, which is a bit bearish for the stock. The MACD also massively oversold, but it's trying to rekindle here even a buy signal. So my investor takeaway would be that short-term naturally bullish because this could go upwards, although it has a lot of resistance above its head. Long-term very bullish. Meta just keeps outperforming here over the long term. Even if you take a look at the weeklies right here, the Meta still always 100-day moving average and still poised to outperform as it always does. There are no other platforms like Meta. It's currently also probably beating TikTok. So the next catalyst would be WhatsApp Business, AI-driven ads, and naturally Reality Labs optional upside. But with Reality Labs, I would be really cautious. Now, in another video, I will go over how I would allocate and at which price targets to this stock. But that video is probably going to come out tomorrow, where we'll show you how to invest $10,000, or how I would invest $10,000 right now and even before the Monday market open. And if you're watching this at a later point in the future, then just keep your eye on that target levels and how they will evolve with time, because I guarantee you, these stocks always give you opportunities to add to them or create a starting position. Don't have to invest all your money at once, don't forget. Okay, so what are the risks here? Risk is high capital expenditure, regulatory risk, of course, strong competition like TikTok and YouTube. But the future outlook is as following: AI ad dominance, WhatsApp monetization becomes a major engine, global user growth accelerates, and VR AI optimization really works. They come up with a super product. So that is one of the bull cases. And the bull bear case is here: bull, AI plus WhatsApp is a driver multi-year growth, and bear case, overspending and regulatory slow margin expansion. And I'm going to tell you right now, the most problem they're going to have is in the European Union because it's over-regulated. Okay, that was stock number one. Now, these are not in any specific order, so let's just jump to stock number two. And stock number two is Amazon. AWS and ads are now Amazon's strongest profit engine, while retail margin improves from automation. Now, again, glance over the earnings. They beat on EPS, margin expansion, revenue for AWS accelerating For advertising, they are faster growing segment and guidance was super strong, I would say. Wall Street focus, Amazon needs to perform on their AWS momentum if they don't want to fall back on the competition, Google Cloud and Azure from Microsoft. Now, the stock reaction right after the earnings, they had a major pop here, Super Bowl flag, but it kind of turned into nothing. And I would say this is just a regular sell-off. This is just signaling this is a great stock. Investors are excited, but you do need to just calm down a bit because everything is really fluffy in the market. The CEO said, and I quote, the largest AWS infrastructure upgrade cycle ever. So CapEx is up now, huge revenue later. Again, clear translation for this. So traders take, I would say, let's just move into a little technical trading here. On the dailies, stock just hit that 20-day moving average, which is now above everything else. So we have the 20 above the 50, above the 100, and above the 200, exactly where we want everything to be. A MACD sell signal was triggered, and the RSI is at 49.82, so at 5, which is fair value, 50, sorry, not 5. 5 would be, whoa, down there, down in the gutter. 50, which is kind of fair value for an RSI, but you did trigger a sell signal. So if this flops around here at the 230, 240, even 227 moving average, then I'm going to tell you later about this. Don't worry about it. I'm going to tell you in the other video where are my price targets actually for Amazon, because this is also, as I said, one of my top 5 stocks to invest in for the next 12 to 36 months. So technicals are looking great here. Future outlook for this is, well, AWS needs to work back 20% growth, which is amazing, a 20% growth. Now, ads surpass YouTube revenue, which is unheard of, and robotics cut fulfillment cost. Also, healthcare and logistics become new profit streams. So the risk here with Amazon is capital expenditure cycle, cloud competition. Don't forget, we have now AWS, Google Cloud, and Azure. Now, of course, a recession would also slow retail, but a recession is a risk for each and every stock that I'm going over here. So just forget about a recession for a moment and think long term. Because if a recession hits, its maximal downturn will be 6 months, and then we're up for the races again. And Amazon will be in the front seat and within the leaders, I believe. Also, they do have some antitrust pressure. This is also within the risk factors. Now, a bull versus bear case, the bull case is AWS plus ads equals miracle. The bear case is capital expenditure surges and macro weakness, as always, with all of these stocks that I'm talking about. Speaking about them, let's jump to the next one. So AWS, the second one on the list, once again, not in any specific order. More about their weighting in a portfolio in the upcoming video. But for now, let's move on to the next one, which is MercadoLibre, ticker symbol MELI. And I chose MELI right after Amazon because this is it. This is Amazon in its early years, but with a catch. Amazon is MELI, not Amazon. MELI, MercadoLibre is kind of a Amazon plus PayPal plus Shopify for Latin America. One of the strongest long-term digital growth stories globally. Take a look back here 5 years or even all time from 2010 or 2008 till now. What a massive run. From $39 a share to now $2,048 a share. This is an expensive stock, I know. But let me tell you a couple of things about MELI. First of all, the earnings were massive bait. Revenue of between 30 and 40%. They did take a little bit of hit on some taxes. Who didn't this year? Guidance was upbeat, growth engine, MercadoLibre, fintech, and Wall Street focuses, of course, on fintech margins improving rapidly. The stock reaction after the earnings, down, up, down again. And in the last couple of weeks, or in the last week actually, we had a bit of a sell-off. But who didn't? Although it does seem like this is in a downtrend, don't discard MELI. Look back here, each and every time this has hit and surpassed its 200-day moving average, it came back with a roar. If you take a look at their technicals, MercadoLibre currently with an RSI of 36, MACD in a sell, signal still triggered. We have no major supports area, so we're going to move from the daily to the weeklies, where we can see the 100-day moving average on the weeklies, which is right here at $1,976 a share. As I said, really expensive stock. its last line of resistance, which is really, really rarely that it hit, at $1,500 a share, right here, the 200-day moving average. But this would be a major support zone for MELI. So valuations currently premium, but justified. Now, future outlook is fintech becomes primary revenue engine, e-commerce adaptation accelerates, the logistic moat protects MELI, the cross-border commerce skyrockets, and also let's talk about risk. There's always risk. The risk would be FX volatility, political instability, and of course, Shopee, Nubank, and Amazon competition. They are in competition with Amazon, and that's kind of a real big one because Amazon has money that no one has almost. And also, always talking about recession, but credit risk during recession. So the bear case here would be the bull case, fintech plus e-commerce equals happy investor. The bear case is FX and political risks may drag on the stock. And now we're going to move to a more global investor, a massive beast, which has a little tiny stock price. And it's not even American. Neither was MELI. It's one of the greats. It's called Brookfield Corporation. What a massive company this is. Now, Brookfield is the world's largest alternative asset manager, owning infrastructure, renewable power, private equity, real estate, and private credit. So you have in your hands, if you own this stock, a juggernaut of diversification. This is a global compounder with massive tailwinds. A couple of the earnings highlights, which they weren't that great, but fee-related earnings growing consistently, a AUM over 900 billion, for distributions, strong capital recycling, guidance, they guided, rising new funds and record scale, and Wall Street focuses, of course, on undervalued relative to NAV. And they just purchased their last stake in Oaktree Capital Management, where Howard Marks, the legendary investor, was co-CEO and well, now still is as a silent partner there. Now, the stock reaction, also by the way, they had a split, they had a 3-2 split back in October, almost the middle of October, 10th of October. And since then, the price went just chopping around here. After the earnings, they went down, and we are currently on a daily chart here. But if you take a look much deeper into Brookfield on a technical level, just first of all, go to the dailies. They're right between their 100-day and 200-day moving average, slightly pointing downwards here, but what isn't in the current market conditions. But again, we're looking for an investment with 12 to 36 months, so 1 to 3 years. And I would say Brookfield in these conditions is a perfect candidate for a strong portfolio. If you were thinking about buying an ETF, I would rather buy Brookfield than an ETF. RSI currently 40, which is underneath a fair value. It's kind of getting oversold here, so I would really like for this to go even further down, reach that 30 RSI, and for then the MACD buy signal triggering back up again. Perfect position to add some more Brookfield shares or even start a position. So future outlook for this company is kind of governed by globally increasing infrastructure spending, private credit overtaking traditional banks, renewable energy adopting acceleration, and Brookfield benefits from across every megatrend. Now, there's nothing without risk. The risks are here, and of course, we're talking about a company who bought a company that was led by one of the greatest risk evaluators out there, Howard Marks, of course. So the risks here are real estate weakness, market sensibility, AUM growth slower in recessions, and multi-business complexity. Because the business of Brookfield is really, really complex. And they're not like Warren Buffett's Berkshire Hathaway with hands off, they're really hands on the management. So let's do a bear bull case scenario here. The bull case will be undervalued global compounder with massive long-term tailwinds. The bear case, macro sensitivity, real estate drag. Now let's move on to something that has nothing to do with real estate, but everything to do with the global consumer. And of course, we're talking here about Netflix, which, by the way, on Monday has its split. So we're splitting in the aftermarkets right here. It's actually no more or no longer a $1,112 per share. It's 1-to-10 split, I believe. But forget about that. Netflix is no longer just a streaming service. It's a builder of global entertainment ecosystem through ads, gaming, and hyper-optimized content. Now, the earning highlights were interesting. After a major earning where they beat on each and every segment, revenue up from ads, paid shares, paid sharing even, strong subscriber growth, and ad tier scaling fast, the stock reaction, well, was down, massively down. After they announced their earnings, the stock went down a massive 13.5, almost 14%. Currently still down, hit that 200-day moving average, and stay there because we have the split. The split is on Monday, on 17th of November 2025, and it's a 10-to-1 split. So the stock of Netflix will no longer be a $1,112 a share. It's going to be a $111 a share from, I believe, after the market opens. A couple of words from the CEO in their earnings was, and I quote here, engagement is rising across every ad-supported region, meaning margins are about to bend significantly. So let's go ahead and do some technical analysis here on Netflix. Currently, yes, kind of in a downtrend, but short term, I would still say bullish. On a daily chart, Netflix is currently under its 200-day moving average, a RSI of 43, a MACD buy signal from a still holding there, but trying to trigger a sell signal. So we could see a couple of weak days still, or even weeks, in these 5 stocks. But the future outlook for Netflix is, for example, ad tier becomes a mega growth engine, gaming increases engagement, AI lowers production cost, strongest global streaming presence that there ever was, right after HBO. HBO was really strong. Now, there are risks here. The risk would be high content cost, but they are keeping that under lid. Competition from Amazon and Disney, but we just saw Disney sales earnings, they were and the stock also reacted accordingly, I would say. Lower ad monetization could also be a downtick here for in a major risk category, and economic churn risk as always, but each of them has that. So bull bear case scenario here, ads plus global scale, huge margin expansion. That's the bull case. A bear case would be rising content costs and competition. So once again, these were my 5 stock picks that I believe will outperform in the next 1 to 3 years. And I just told you my convictions. Now, how I would add to these stocks, how I would add them to my portfolio, I'm going to show you in a later video on just after this one. But you know what? I want to hear your opinions on these 5 stocks. Should I eliminate one of them? Let me hear it in the comment section below. I'm Norbert Menhardt, and I build and protect health right here at WealthFarm. So like and subscribe, and catch you next time. Bye-bye.